I'm going to talk today about a conventional loan hack where we can get low income, high asset borrowers approved with Fannie Mae for conventional financing. That hack is trust distribution income. So let's talk today about a few real scenarios that we're dealing with today. The first is a self employed person.
Yes. So you're self-employed. Typically, most people that are self-employed like to take advantage of the opportunity to do some write-offs. It's a great opportunity for them to save money on their taxes on a yearly basis. However, that can be bad when you're wanting to apply for a traditional loan like a Fannie Mae conventional loan. Reason being is because we use what their net income is and not what their gross income is. However, you're self-employed, but you have a lot of assets.
So let's talk about in a normal situation, right? Or what most people assume is that their only option in that scenario is to do more of a non-traditional loan, right? So let's say this self-employed person has a lot of deposits coming in regularly. They would maybe do a bank statement loan program. But why is a bank statement loan program not as beneficial as, say, a traditional Fannie Mae loan?
One problem with a bank statement loan is first, it's not a traditional loan. So the cost of doing a non-traditional loan is far more expensive than doing your regular conventional loan.
You're going to pay more upfront and a higher interest rate.
Yes, exactly.
The other thing is it's going to take longer to close, right? Which puts you less competitive against other offers. So how is somebody going to qualify in that scenario that has a lot of money, right? And is large in assets, but just doesn't show the income because they're writing off at a loss, let's say.
So here's an example. Someone has $360,000 in the bank. If that individual wanted to open up a trust, obviously they need to contact an attorney. Fees will maybe range from $1,000 to $2,000 depending on the attorney that you work with. But if you moved that $360,000 into a trust and you had control over the trust, you could then allocate $10,000 a month into your bank account, and you would just need one deposit before the close of escrow, and you could have $10,000 in qualifying income because you have 36 months worth of income in that trust account.
So a trust distribution means you're taking a distribution from an asset that's in a trust to you as an individual. And so to Jack's point, you need a 36-month continuance of that trust distribution income. So whatever amount you have as an asset, you can divide that by 36, and that can be a qualifying monthly income that can be used. A second scenario, right, would be somebody that really just hasn't earned a lot of income or just doesn't have a lot of income. So I'll give a recent experience that I've had where I had a borrower who recently sold her home in San Francisco, made a lot of money on the close of that sale. She's somebody who's been self-employed her whole life, so doesn't have a 401k or an IRA, and she's of retirement age now. And in a normal scenario, right, she talked to another lender who proposed to her either one, a non-traditional loan, right, which was at a really, really high interest rate. The second scenario that they proposed was a reverse mortgage. Now, the challenge with her, or I don't want to say the challenge, but the reason that I didn't like a reverse mortgage for her is she's only 64 years old. She's of great health. So obviously she plans, right, to be in this home and in this loan for at least the next 20 years. So what we were able to do for her, right, is she had excess of liquid assets of over $500,000. Well, the easy part here is she already had a trust. So all we did was open up that trust account or open up a new bank account in the name of the trust and start that distribution. It literally took her one trip to the bank and we could qualify her for a loan immediately, right? She was able to secure the house she wanted right away at terms that she was really happy with.
Mm-hmm.
This was a game changer for her, game changer for the agent that was able to write it at a really, really aggressive contract time frame.
Mm-hmm.
And everybody ended up winning in that scenario.
And something I want to point out about that scenario as well is, say she goes with lender number one and she does a bank statement loan. That doesn't change her qualifying status with that lender. She wouldn't be able to refinance without this loophole with her regular income. She would have to stay in that bank statement loan at that high interest rate for the time being until she was able to figure out something
It's
like
a great
this.
point. And most of those loans are also adjustable.
Mhm.
So maybe she would have gotten a 9 to 10% adjustable rate mortgage with literally, to your point, no real path or avenue out of it.
Yep.
Right? So yeah, she's going to have the house she wants, but not at the payment or affordability factor that she can sustain going forward.
Yep.
So anybody that has any questions or thinks that they might have a client that fits this situation, let us know. It is a little, it's intricate on our side. We want to make sure that the scenario fits, but this is a great hack for, again, people with high asset, low verifiable income.